Dangerville here, and welcome to part 2 of the Entrepreneur's Ultimate Tax Guide, brought to you by Excellence in Execution Planning. Today we're going to be talking about how your business taxes are actually calculated. If you remember from last time, we talked about how understanding your business structure is very important because this is how the IRS determines how you're going to pay your taxes. We talked about there being 5 common business structures: C corporations, S corporations, partnerships, sole proprietorships, and limited liability companies. And that the major difference is that C corporations are taxed completely separate from the business owner, while S corporations, partnerships, sole proprietorships, and some limited liability companies, they're taxed as a pass-through entity or on pass-through income, meaning that the business taxes get paid for on the business owner's personal tax return. We're going to talk about how this works by using an example. In fact, let's start off with a C corporation. Let's say we start a C corporation and we name it Example Inc. Example Inc. has 3 business owners and at the end of the year has brought in a revenue of $150,000. And after deductions, which are expenses used to reduce taxable income, discussed later in our next lesson, we have a net income of $80,000 for the year. Now, according to the corporate tax rate table, which you can download from our website at aneplanning.com, our Example Inc. gets taxed as follows. The first $50,000 is taxed at 15%. Income between $50,000 and $75,000 is taxed at 25%, and the remaining $5,000 is taxed at 34%, meaning that our Example Inc.'s federal tax liability is $15,450. But we're not off the tax hook yet, because if we as owners decide to take dividends, wages, or salaries, then that money is taxed on our personal taxes, completely separate from the business taxes. Which brings up the idea of double taxation, which is an issue faced by C corporations. Now, let's take a look at how pass-through income works for sole proprietorships, partnerships, S corporations, and some limited liability companies. Let's say our Example Inc. is a partnership with 2 business owners. Each of them own 50% of the company. In fact, let's name these 2 owners Jack and Jill. At the end of the year, Example Inc. makes a revenue of $200,000. And after deductions of $80,000, that leaves a taxable income of $120,000, which is passed through to Jack and Jill based on their respective ownerships. Which means that since both Jack and Jill own 50%, they both have to report $60,000 on their personal tax returns. Now, how each owner will pay taxes on that income depends on their personal situation. For example, Jack is married and with his wife's income has an additional taxable income of $130,000. So his total taxable income is $190,000. Looking at the following table for married taxpayers, we see that any income that falls between $115,725 and $206,675 is taxed at 33%. So the $60,000 from Example Inc. is taxed at 33%, which means Jack pays $19,800 on his share of the business income. Now, let's take a look at Jill's situation because it's a little different from Jack's. Jill has a second job and ended up with an income of $355,000 from that job. So, when you add her share of Example Inc., her taxable income is $415,000. So based on the single taxpayer's rate table, we see that she crosses 2 tax brackets. So the $60,000 from the business income gets treated as follows. The first $58,350 is taxed at 33%. The remaining $1,650 is taxed at 35%. totaling Jill's taxable income at $19,833. Now I know that was a lot of math, but we needed to use that to illustrate just how important understanding your business structure is, because this is how the IRS calculates your taxes. With this information, you could give careful consideration to the type of business you want to open based on how you want to be taxed. On the next lesson, we're going to be talking about 5 simple strategies that you can use to set your business up for success when it comes to paying taxes. So until next time, keep moving forward.